Hi everyone, this is Rob Roy of Elliott Options, and welcome to this edition of the U.S. market update. Last week when I was talking to you, the market had just fallen. Big following President Trump's tweet that additional tariffs were going to be put on China starting September 1st, and now they're going to include retail goods and things like that. It's a little different scenario and possibly a little more effect on the economy, so that sent the markets to the downside. So if you haven't watched that video, go back and take a look at it. And if you're new, don't forget to hit the like button. And we also, last week, I shared with you a trade that was going to be sent out. It was sent out to the subscribers looking for a bounce from that downward move, and we actually did do that. I'm going to show that to you as well. This recording I'm going to call How Low Will They Go? And what I'm talking about is interest rates. How low are rates going to go? Because that's having a direct effect on the market. In fact, right now, the bond market and the equity market are kind of moving in lockstep. They're moving together. I've always said that if you're going to be a successful trader in the equities markets, you need to understand the bond markets. It doesn't mean you have to be a great bond trader, but you better have a general knowledge of the bond market and how it affects the stock market. There's an awful lot of really good traders in the bond market. There's more money in the bond market than there is in the equity market, so they affect each other, and it's important to have that good understanding. So just keep that in mind. Let's go ahead and take a look at the charts, and I'll update you on that trade, as well as talk about where we might go from here. So here's the current chart of the market, and I'll go ahead and draw those fib lines so you can see the bounce that we were talking about, and that was when we came right down here to the 61.8% fib retracement. We closed right on that level. We were oversold at the time. If we put the moving averages on, there was big separation from where we were in the 10-day moving average. So the markets were oversold, and we were just looking for a quick bounce. That's all, just a quick bounce from an oversold condition. And if we were going to bounce, that was going to be the time, because this is a very strong Fibonacci level of 61.8. It's my favorite level. And as I said, we did do that. Here's the actual trade. This is what the alerts look like that we post on our website. These are the same alerts that we send out to our subscribers via text message or email or both, and then we post them on the website as well. And so you can see here, it was a one-day trade. We made 25%. Entered it on August 5th, exited on August 6th. One-day trade, 55 cents, and exactly a 25% gain in one day. We sent out 2 contracts because we have a maximum risk limit of $500. However, our subscribers are free to put as many contracts as they want depending on the size of their own account value. So quick 25% in one day, and again, that gives you an idea of what our alerts look like, and we even include the chart and the same chart that I showed you, etc. So all this data is stored on the website. People can go back and visit it later on in the day, whatever, after they receive their text or email alerts. So if you're interested in this, down at the bottom of the page there is a link. Hit that link for to sign up for a free subscription to Trade Finder. Trade Finder is basically a publication that I do that goes through in details each week how I've identified particular trade alerts that were sent out to the subscribers using Elliott. So it's all Elliott based, and you'll get a good idea of the analysis that I go through from the technical system that I've built around Elliott. You're familiar with it from watching these recordings over the past year and a half plus, but that'll give you an idea on the individual positions as well as just the general, not just the general market. All right, so here we go back to the charts. So we caught that bounce, the one-day bounce, and then the market went sideways, and then another up day. We were just in the one day. We were just looking for the oversold bounce. So when you get what you're looking for, you close it out. 25% in one day is nothing to sneeze at. And so then we moved back up. We hit that 10-day moving average, filled the gap, and now back down in the market move lower today. Now, if I take this stuff off, you'll find it's pretty crude, but it exists as well, a triangle. Now, I said it's a pretty crude one. It's not very well formed, but it is indeed a triangle with a pretty good size mouth to the outside of the triangle, which means that we're probably going to make a decent move here in the near future. The problem is we don't know which way. I know that we're looking here. We're still technically in the wave 5, and we will be until we violate this or move down past the 61.8% fib level. We could actually relabel all this into a complex wave. It's too early to speculate on that. But at this point in time, we could break back to the upside to new highs and have this zigzag formed here. We're talking about, so this would be an A, B, C potential zigzag. And that was in the Goldilocks scenario, which, by the way, still does exist. The potential for this to work out, and what that scenario was. And I said, in my opinion, the percentage was kind of lower on that, and I think it's even lower now than it was because of all these geopolitical things going on. But it does still exist that President Trump, even though I really think he's playing with fire here with these tariffs and in danger, there's so many algorithms in the market that are just automatic, that if you break the market technically, those algos are going to kick in, and we could have a big move to the downside that might be more than what the president is expecting. But it could work out, and here was the scenario that I gave last week, that we get the market to back off a little bit. The economy looks weak, which it does globally. It's where the probably the best shape here in the U.S., but around the world, everything seems to be falling apart. And that could spur the Federal Reserve to get those extra rate cuts that the president wants. Then after he gets those cuts, then maybe he comes back and cuts a deal with China, and off to the races we go. And there's that Goldilocks scenario. They're talking about he gets his rate cuts, the deal gets done, and we're off to the races to the upside. But some problems with that. Again, the technical damage to the charts and the potential for China to say, hey, we don't want to make a deal until after the election. They may roll the dice and see if President Trump gets reelected. If he doesn't, they may not have to make a deal. And if he does, they're like, okay, well, we'll just do it then. But China's got a lot of problems with Hong Kong and everything else that's going on right now. So there's a lot of unknowns right now. But take the key from the bond market. So when you get to this point, like here we are with this triangle, we have the potential for a C wave in the upward zigzag. I'll label this here, the A and B. The C is potentially there, and I just gave you this scenario on how that could work out. That would have to occur in a relatively short period of time, obviously, but the potential is there. And then we also have the downside issue that could occur as well with China not wanting to make a deal and the technical damage being done to the charts, and then down we go to the downside. I also wanted to show you this real quick. You take a look at the SMH. Remember when we were talking about how strong that chart looked? We were in this wave 3 here. We had made the new highs. Not so much anymore, right? So here we are back headed down in the wave 4. But look at this. Look where the wave 4 caught itself. This is what I wanted to show you right there at that 61.8% fib level, the same level that the actual S&P caught itself. And that was why we put on that trade for the bounce. So we've closed this gap. We actually, believe it or not, that was a tiny gap there that got closed today. I know it doesn't look like much, but gaps get filled. It was only a 10-cent gap, but it was still a gap. It's filled today, so that's done. Market's free to go where it wants, but I did want to update you on the SMH because a lot of people believe the semis are important to the market. And from a technological standpoint and talking about the strength of the economy and growth, etc. So big downward move there, but caught itself right at a very strong point. If this gets violated, if this 4 gets violated here, then the SMH is coming back down here. It's going to retrace that entire move. So that's something to watch, and you're don't have a whole lot of room here if it violates that and moves lower. Now here's what I wanted to talk about. TBT. Again, we've looked at this before, but the yields. And if we do our fib extension, you already can see right down there where it's at 158%. It puts that on the chart for you right there, the 158. So the 161.8 is the next fib extension level. We're already in a very extended wave 5, the wave 4, 38%, again, another primary fib level, and then the catching itself at 61.8, it bounced, tested the previous level, came down to the next one, went sideways for quite a while at the 100%, and then boom, just fell in a very short period of time to the downside. And when yields start falling like that, it's an indication of softness in the economy. That's what's causing people to get a little sketchy about the equities market, is the severity, because you can see how much more vertical this move to the downside has been versus the rest of the downward move. Yes, rates have been coming down, but not as violently as they've been coming to the downside now. So that's spooking the equities market a bit. But remember that scenario we talked about with the potential of the upward C wave here, possibly breaking out of this crude triangle that we have. That could occur if we come down and hold this 161.8% fib level. That would be a logical point of support. Again, it's already a very overextended C wave in this zigzag here and also in the wave 5. So that would be a logical point of support, and we're almost there. So rates don't have to go very much further to get there. However, if they don't hold there, check this out. Now, this would not be a good scenario for the market, for the equity market. So I'm going to include in the next fib level, which is the 261.8% fib level. If we don't hold here, that's where we're going. Some people think that that's where we're headed eventually, and that would not look good for any sort of an upward move out of the equities markets. If rates go down that low, then we're probably headed significantly lower in the markets. We might even come back all the way down and test those December lows. That might be a little bit confusing. People saying, well, I thought the president wanted the Federal Reserve to cut rates, so why is rates going down a bad thing? Well, it's because rates are continuing to fall even without that one rate cut that the Federal Reserve did. And this is indicating economic weakness. It's not where you have a good, real strong economy and lower rates give you that extra. It's like the liquidity heroin we've been talking about, where the market's been addicted to this easy money. It's a little different scenario. Looking at the VIX, you can see that we bounced back up today with a downward move, and we did take out those highs from May, but not a whole lot on the charts with the VIX, and we're still in the corrective pattern, so we're not in a wave 3, thank goodness, at least not yet in the VIX. Anything could change when we break out of that triangle. But then I also wanted to show you another thing that we've done. Now, we had 2 alerts that we sent out and caught upward breakout moves in GLD for subscribers. Silver tends to follow gold. Historically, it's usually what occurs. Now, there have been periods of time where silver led gold, I know that, but historically, most of the time, silver follows gold. So we're looking to catch a continued upward move in silver, and that's also a protective level in case we've got puts on all our strangles positions in our volatility portfolio. But if we were to get a downside breakout due to the fact that these yields don't hold this area or break down through there, if that occurs, then the metals, gold and silver, both will likely take another leg higher. And silver being so low, the SLV, you can buy a bunch of contracts for a small amount of money. So that's where we go. How low will they go? Well, it's going to tell an awful lot about where the equity markets go. So that catches you up to date. Look forward to talking to you again. Take care, everybody.